Hi, this is Greg. Welcome to the channel. So, Jeffrey Gundlach is a famous investor. He manages $96 billion of money. He's a billionaire, and he's also referred to as the bond king. I'm going to play you a clip that I find very interesting where he talks about the changes in the inverted yield curve that have happened over the last 18 months and how those changes and the narrowing of the inversion could be pointing to a potential downturn in the economy and a recession. Very interesting observation as to how a bond guy looks at this. And I've said many times that if you want to understand the markets, and more specifically the stock market, look at the bond market, because I believe that the participants in the bond market are on average much smarter than the stock market investors, which has a lot of nonsense and a lot of emotion. The bond market is much more quantitative, and some of the smartest people on the planet are active in the bond market. The other thing he brings up, which I think is extremely interesting, is the discrepancy he sees between the state unemployment numbers, if you look at them from a state-by-state basis, and then if you look at the national unemployment numbers and some of the leading indicators that you're getting from the government. The two things are not coinciding and matching up, and he's got some very interesting observations in that regard. Check out this clip.
Yes, well, the yield curve has been inverted now for about 80 weeks, maybe a little more than 80 weeks, which is, I'm talking about 2s to 10s, and you can look at almost all comparisons. They've been inverted for about that time period. The only episode that had a longer period of an inverted yield curve before the recession came was in the late 70s, early 80s, which interestingly was also the last time we had an inflation fight going on, although that one was much more difficult than this one appears to be. So I think, though, the thing on the yield curve that's important is the 2s, 10s was negative 108 basis points. The 10-year yield was lower than the 2-year yield by 108 basis points, and now it's 18. And when you start to de-invert, you really get to be on recession watch. Mm-hmm. And the fact that recession hasn't come after 80-plus weeks of yield curve inversion is a very bad logic to say it's not coming, because the de-inversion is happening. When it comes to leading economic indicators, they've fallen for 21 consecutive months. But the thing that's wrong about historical comparisons, or misleading perhaps about historical comparisons, is this economy has been very strange in that manufacturing was very strong in 2021, 2022 with all that stimulus that came in. And it went to a lot of durable goods, type of products. And the leading economic indicators are skewed towards manufacturing. So it's not surprising that they've been weak for a long time, because they're very manufacturing oriented, and manufacturing is very weak. But the economy handed off the GDP, if you will, to the services sector starting about 18 months ago. And that has skewed a lot of these economic indicators. So the leading economic indicators have been very negative for a long time. The yield curve has been inverted for a long time. But the thing that I'm most concerned about now economically is reports coming from the states. We look at national unemployment data, and I heard in the previous segment talking about that. I thought it was a good conversation. But the states release unemployment data too. And amazingly, 88% of the states, and I think they have DC in there, so there's 51 of them, 88% of them are reporting rising unemployment over the last 6 months. And I'm having a very hard time squaring this circle. If 88% of the states are reporting rising unemployment, how can it be that national unemployment remains stable at a very, very low level?
Right.
I guess the only logic would be that the other 12% of the states are making up for all of that rising unemployment, which is kind of hard to believe, because those states, while it includes Texas, and I think includes Pennsylvania, it also includes North Dakota and Wyoming. It's hard for me to believe that this set of states can offset rising unemployment in Florida, Illinois, California, New York. And so I'm skeptical about this data. And so I've noticed that in the JOLTS survey, that job openings thing that was getting a lot of play because it was so elevated, the percentage of surveyors responding to the survey used to be 75%. And now it's down, I'm talking about maybe 5 years ago, and now it's down to 35%. So what is going on here? That suddenly 35% responding. I wonder if the survey data is really comparable to past periods.
There's no doubt.
I don't know. Go ahead.
No, I was just going to say there's no doubt that we should. There's a lot less reliable. They feel a lot less reliable. By the way, I was going to say also with the states, the so-called SOM rule, the speed of which some of these states are losing jobs or the unemployment rate, 20 are technically in recession already.